Everyone. It is Kelly Dahlbach, Executive Business Coach for corporate employees ready to embrace business ownership. I am so excited to be coming to you live today with a critically important topic and probably the greatest pain point when it comes to making a transition from traditional corporate employment into business ownership. We can see where we want to be and we can vision our life and the freedom and the fulfillment that our impact business is going to make. But getting the information to actually make that a reality is a huge and necessary component of the plan for this transition. So I am not the expert in finding your business entity or tax deductions, but I do know and can resonate with how critically important it is for not only peace of mind, but bringing in expertise in this area. So I'm excited to welcome today a friend and peer entrepreneur that I have met throughout this journey, Merill Taylor. Merill is a CPA and has 20 years experience working with taxes. He started much like you and I in one of the big four corporate accounting firms, Ernst & Young in California. And Merill currently owns his CPA firm and now has a staff of individuals that assist his clients with tax saving strategies and bookkeeping for self-employed, franchise owner, real estate professionals, but really small business owners that are looking to embrace their entrepreneurial and creative spirit. So let's welcome Merill to the table. Merill, good day. I think you're out in mountain time. So thanks for joining us this morning.
Yeah, thank you. Excited to be here.
Good deal. So, all right, if we get into the nitty gritty, Merill, I know you are going to address the important questions about entity and tax deduction because many of individuals are at the point where, how to replace a corporate salary and really make this dream come true. And so I know you're going to talk and share some slides and some decks, and this recording will be available on all of the live streams as well as available via email. If you need a copy or need to contact Merill or I, we will leave our contact information in the comments. And Merill also has a special offer and opportunity for those that are in the creative stage of business ownership. And what does that look like from an entity selection? So stay through to the end to claim that special offer, and we can get you connected with the information to take the next steps in your journey. So Merill, the first thing I want to ask you, I want to get to the very tactful things where you're actually going through the definitions of entity selection and tax deductions. But, you and I think we're part of this trend. You started much earlier than I, but we see in a recent poll that up to 40% from 34% in December 2020, according to a survey, said that workers had reported having side hustles. And so I just want to get your feedback, right? What is a side hustle what you see as kind of the entry point for many of these business owners? It's a fascinating statistic for me. And I'm just curious through your lens, if you see that sometimes as a starting point.
Yeah, certainly we do. Working with clients, we work with business owners as well as we have a number of clients that we just do their 1040 that they're employed and they get a W-2. And quite often I'll have a client that will reach out. They know that we do their individual return, but they'll reach out and they'll say, hey, I'm thinking of starting a business or starting something on the side. Do you help with that? Help with businesses? And, I always kind of laugh a little bit because that's kind of primarily what we do. But yeah, we certainly see that they'll start like a little business. They'll send us their tax information and say, oh, by the way, I started a business. And quite often we'll see that little business start to grow and grow and grow. And eventually it overtakes and they're no longer an employee. They're now self-employed because their business was able to take off and go. So yeah, usually it starts off with that little side hustle and then they prove that concept and then they're able to scale and grow it from there.
I love that. And so what I'm hearing from you, kind of what resonates, is that you don't do it all at once, right? Rome wasn't built in a day. And I think really truly allowing the mindset that this can start any which way that is comfortable for the individual, moving from corporate employment to entrepreneurship, is really a critical point in unleashing that creativity, right? I have some clients, I'm sure as you, that they're still working full time. They have a side hustle. Maybe they're halfway. Maybe they're doing some consulting, some part-time work, and some of their side hustle. It's really all about the planning, the communication, bringing experts in. So let's not pigeonhole ourselves in our creativity, because it sounds like the path and also the supportive entity selections allow you to be creative, and isn't a one size fits all. After all, that's what entrepreneurship is.
Right. Yeah, exactly.
All right, Merill. So I'm going to go ahead and allow you to share your screen here. I do have my eye on the chat for any individuals that have questions. Pop them in the chat, and I'll do my best to break in when we have a question. And I know today we're primarily focusing on entity selection as well as tax deductions, but as time allows, we will take questions in the chats through any of the Facebook, LinkedIn, or YouTube. All right, Merill, take it away.
Perfect. Thanks, Kelly. I appreciate that. Yeah, as Kelly mentioned, my name is Merill, the CPA. I've been doing it for a while. And I enjoy teaching about taxes, especially this kind of course or class that we'll go through here. I've taught it a number of times and really enjoy it. If I could do just teaching, I would certainly just do that. There's my contact information if you have any other questions. I also have a YouTube channel. All the things that we'll be discussing today, we'll touch on a bunch of things here and there, but I have much more in-depth videos on that YouTube channel. So that's a great resource as well. All right, so we'll jump right into it here. Okay, so the first thing when it comes to taxes is people always wonder, what type of entity should I set up? And a lot of times they think that you set up an entity with the IRS. However, that's not the case. When you go and set up an entity, it is set up with the individual state of where you reside, or sometimes those entities are set up in a different state, in another state. Where you set up your entity doesn't really matter. There's all these commercials on radio and TV and other places that say, incorporate in tax-free Nevada, or some other tax-free state. And it's true that Nevada does not have an income tax. However, just putting your entity in Nevada doesn't mean you're not going to pay any tax. The way that it works for tax purposes is you are taxed wherever you operate that business. So if you live in California and you set up your entity in Nevada, well, that's fine. California doesn't mind where you set your entity up. They just want to make sure that you're paying your tax in California because that's where you're operating your business. So your legal entity is set up with the state. There's 4 different types of entities, basically. There's a sole proprietor that's not really a legal entity, and we'll talk a little bit more about that. You can go to the state and set up a partnership. You can set up a corporation, or you can set up an LLC. The LLC is the most popular entity to set up. Then it comes down to, how are these entities taxed? How does the IRS recognize these entities for tax purposes? Well, here are our tax entities. So we have a sole proprietor that's the same as a legal entity. We have a partnership, and then we have a C corporation, and we have an S corporation. You can see there that we didn't include LLCs in the tax entity list. The IRS doesn't really recognize LLCs as an entity. When you have an LLC, you have the legal protections that come with an LLC as you set that up legally. So those are helpful. But the reason why the IRS doesn't really recognize LLCs is because LLCs are relatively new in the tax world. LLCs were invented or came up with by the state of Wyoming back in 1978, which puts them about 44 years old. I was born in 1979, so they're like 1 year older than I am. The tax code has existed for a lot longer than that. And when the tax code was written, it was written for these 4 types of entities: sole proprietor, partnership, C Corp, S Corp. And then Wyoming came up with LLCs, and the IRS says, we do not know what to do with LLCs. And it took them 10 years to decide what to do with LLCs. So during the 80s, the IRS was trying to figure it out. And then by the late 80s, they finally figured out how to treat them. And then in the 90s is when LLCs became more popular, because now we knew how the IRS was going to treat them. And so the IRS said, okay, LLCs, we can write new tax code for LLCs, or we can figure out a way to make LLCs work in our current tax code. And that's what they decided to do. That instead of write all new tax laws, they decided to just make LLCs fit into the current tax code. So they said, if you set up an LLC and you own that 100% yourself, then for tax purposes, that is considered a sole proprietor. And on your tax return, you'd file a Schedule C, and we'll get into that in a minute. But they're basically treated as just a sole proprietor. The IRS doesn't even recognize that an LLC exists. They recognize that as you. That's another common misconception. People think that you need an LLC or a legal entity to do business, but that is not the case. I give an example of my sister. When she was in high school, she tutored a family down the street, and that family paid her to tutor. She was self-employed. She was a sole proprietor. She had no legal entity. She didn't have insurance. She didn't have a business license. She didn't have anything like that. But she was a sole proprietor for tax purposes. And when we prepared her tax returns, we did a Schedule C. We reported her income. We reported some expenses. She was in business. And so that's the same thing. If you set up an LLC, it's treated, and you own it 100% yourself, it's treated as sole proprietor. Then the IRS said, okay, if you set up an LLC and it's owned by more than one person, for tax purposes, we're going to treat that as a partnership. And then they went a step further and they said, okay, and if you want your LLC to be treated like a corporation, you can file an election and we'll treat it like a C corporation, or you can file a different election and we'll treat it like an S corporation. So an LLC is kind of unique. So when somebody comes to me and says, you know, I need help with taxes, and I say, okay, what type of entity do you have? And they say, I have an LLC. And it's like, okay, that's great. I'm glad you have an LLC. That's protecting you legally, but I don't know if that's a sole proprietor, a partnership, a C Corp, or S Corp. So then we start asking questions of who owns the LLC? Is it a single owner? Is it a multi-owner? Were any elections made to treat that LLC like a corporation? So so there is no such thing as an LLC tax form with the IRS. Instead, there's 4 different ways to file.
Perfect. Well, there definitely is. I hear that interchangeably, and it makes sense now that you've kind of shared their history of that, Merill. But I think there is an important component is that you say you don't necessarily have to have an LLC to create income. But I think the really important part is that legal separation and the protecting you legally from yourself and your self-income and your what do you call it? Independent. Trying to think of a word for, your business income and then your individual independent. What am I trying to think of? Well, for filing maybe. Basically, when you do it, you have the protection that in many cases what you do in your business is not going to pose risk on your individual financial security. Is that fair?
Right. Yeah. Exactly. Yep. Perfect. Thanks. And so, we'll jump into these a little more. So like a sole proprietor, if you were to set up a sole proprietor, it's the simplest form of doing business. Because just like my sister, she just got paid. And so she was automatically in business because she got paid outside of a W-2. Anytime you get paid outside of a W-2, the IRS views you as a sole proprietor. So it's simplest form of doing business. There's no liability protection, which is the huge downside. And then you file a Schedule C with your Form 1040. So you don't have to file a separate tax return in that case. It's just a 2-page Schedule C that reports income and expenses, and that's it. It's fairly simple. Then the next level would be a single member LLC. So now you go and you set up an LLC with the state and you own it 100% yourself. So for tax purposes, it's still treated as a sole proprietor. You still file Schedule C with the 1040. There's no difference in that example. If my sister in her tutoring would have set up an LLC, it wouldn't have changed the filing in any way. It wouldn't have changed the deductions or anything else we could take. It's the exact same. The difference that we have now is now we have liability protections. So if somebody were to try to sue you or come after you for some reason, you can have liability protection that way. So that's helpful. The next level is that we have a partnership or an LLC with 2 or more owners. So the IRS treats an LLC with 2 or more owners as a partnership. The advantage of a partnership is that you can allocate income and expenses by partner. So those can be owned, let's say you have 2 partners in there. They can be owned 50-50, 40-60, 90-10. You can kind of mix that up any way you like. You have liability protection as an LLC or as a partnership. And then those start to file a Form 1065. A 1065 is a much more involved form than a Schedule C. You report income, expenses. There's a balance sheet that goes on there. There's a couple pages of questions that the IRS asks about the entity. And then you've got K-1s that go to the owners. So it tends to be a much more significant filing than just a Schedule C. And then we have S corporations. S corporations are becoming more and more popular of a way to do business because an income of an S corporation is not subject to employment taxes. All the entities that we've talked about so far, a sole proprietor, single member LLC, a partnership, all of that income is subject to both income tax as well as employment taxes. So you pay kind of 2 levels of tax with that. With an S corporation, the income is not subject to employment taxes, but because the income is not subject to employment taxes, you have to take a salary from the S corporation. So S corp owners are required to set themselves up on payroll and pay salary. You get a liability protection based on how you set up legally. If you're an LLC, you have the protections of an LLC. If you set up as a corporation, then you have the protections of the corporation with the state. And then that files a Form 1120S with the IRS, which is similar to a partnership return. It's multiple pages, income, expenses, balance sheet, K-1s, all that stuff get reported there on an 1120S. All right. And then for C corporation, so a C corporation is subject to 2 levels of tax. It pays tax itself at the corporate level. And then when it distributes money to the shareholders, to the owners, those owners then pay tax on the dividends that they receive. You get full liability protection, and then you file the Form 1120 with the IRS. A lot of people think that if they don't take money out of their entity, they won't pay tax on it. So I get that all the time. Somebody says, oh, hey, I formed an LLC last year. We made $50,000, but I didn't take any money out. And they think that they won't be taxed. That is not true if you have a sole proprietor, a partnership, or an S corp. Those are all considered flow-through entities. So any money that is made inside those entities are taxed at the individual level. They flow through to the 1040 and get taxed. A C corporation is the one entity where you do not get taxed personally on what the corporation makes. And that is because the corporation itself pays tax. So there is no way that I know of for a business to make money and somebody or something not pay tax on that money. So just keep that in mind, that if your business makes money, tax is going to be paid at one level or another. I wish it was true if you had an LLC and you didn't take any money out, that you didn't pay any tax. That would be awesome. That would be like the best tax planning strategy ever. But unfortunately, the IRS wants their money as soon as they can get it. So that doesn't.
That's not the big reveal. That's not what you're here to give anyone tuning in today.
Right. Yeah.
That's okay. That's okay. This is still super helpful information. I can see some comments coming across, Merill. So super helpful and very, very, very different. Now, when you'd say that there's one question coming in, making money, is that any revenue, or is that complete loss, like total year loss revenue after expenses?
Yeah. So taxes are always after expenses. So, if you bring in $100,000 of gross revenue, that's what you collect from customers and clients. And then you have, say, $60,000 of expenses, then it's the 40,000 that you're taxed on. That's your net income. And if you bring
Yep.
in 100,000 and spend 120, you have 120 expenses, then you'll have a loss. So there is no tax due in that case. And that loss could then help to offset other income on your return. And that's often how we see businesses as they get started up. Usually they have some kind of a loss to begin with, and that is beneficial to them at the start.
Yep, and we'll move more into that, but great question, and very helpful answer. Thank you.
You're welcome. All right, so that covers entities and going over those entity selection. Sometimes people get stopped at, they just don't know what entity to set up. The advantage of kind of not of LLCs being able to pick however they want to be taxed is very beneficial in that way. So I always tell people, just set up an LLC, and then you can actually change between any of these at any year, at any time. So if you set up an LLC and you own it 100% yourself and it's just considered a sole proprietor, that's fine. The moment you bring on a partner, it automatically turns that LLC into a partnership for tax purposes. And then down the road, let's say you're bringing on investors, and we often see this, people will bring on investors, and the investors require that entity to be a C corporation. So then at that point, years down the road, after the LLC has been established and operating, the form is filed with the IRS to turn that into a C corporation for tax purposes. And then usually what happens is people start up an LLC, they operate it for a couple of years, and then they get to a point where it's more advantageous for them to have an S corporation than to be a sole proprietor. And so at that point, they make that S corp election. So if you set up an LLC, you will not go wrong because for tax purposes, we can always convert that into any other type of entity for taxes that way. So that's helpful.
It just has to be a year filing, right? So you have to say an entity for the purpose of a full year filing.
Right. Yep.
Okay.
Yeah. And it could be split. Like, if you're a sole proprietor, a single member LLC, and you bring on a partner in the middle of the year, well, then for part of the year, you'll file a Schedule C, and part of the year, you'll file a 1065, a partnership return. Usually C Corp and S Corp, you're cutting those off at year end, but you could do those in the middle. S Corps are usually year by year, but you could have a split year for a C Corporation. I have a client that did that last year. They were a partnership for first couple of months, and then they brought in some investors that required them to be a C Corp, and so they transitioned to C Corp in March, and so they'll have a split year that way.
Perfect. Thanks.
Okay, so now we get into business records and the importance of business records. Business records we should keep separate from non-business records, and you want to open a bank account to use for all business transactions and avoid cash transactions where you can. The reason for this is if you get audited by the IRS, it's really, really difficult to prove cash expenses to the IRS. The IRS wants to see two things in an IRS audit. They want to see proof of the expense, and they want to see proof of payment. Proof of the expense usually comes through a receipt. You give the IRS a receipt. They can see that, yes, you had a valid business expense. And then they want to see that proof of payment. And if it's a cash transaction, it's really difficult for them to prove that you actually paid that. But if it runs through a bank account or through a credit card, it's very easy for them to see that money went out of your bank account or money was charged to a credit card that was eventually paid off with money from a bank account. And I give the story of a client that was under an audit by the IRS. I didn't prepare the returns that were under audit. He came to us when he was under audit asking for help. And his problem was that he had an LLC that he owned 100% himself. So it's a sole proprietor. He filed a Schedule C on his tax return, and the IRS decided they wanted to take a closer look at that Schedule C. So they audited him. And when the IRS audits you, they always ask for your bank account, your bank statements. And they go through those bank statements and they add up every single deposit that goes into your bank account. They add up those deposits, and then they take those deposits and they compare them to the amount of income reported on your tax return. So they did that for this individual. They added up all the deposits, and the deposits were more than the income that was reported on his tax return. So now the burden of proof is on my client to prove why he had more deposits in his bank account than he reported on his tax return. So we had to go through every single line item one by one and see what it was for. And since he didn't have a separate bank account, the IRS was going through his personal accounts because it was all mixed together. And in his personal accounts, he had a deposit for $20. And, he said, oh, you know what? That $20, my sweet grandmother to this day still sends me money for my birthday. That was my birthday money from my grandmother. And then there was another deposit for $15. And he said, oh, you know what? My wife and I, we went to the movies with some friends and we paid the tickets and our friends paid us back. So that $15, that was back when $15 would buy you 2 movie tickets. That was them reimbursing us for movie tickets. So you have to get into that granular of level if you don't keep your business and personal separate from each other.
Okay. Great stories, great examples, life lessons. And I too had received that advice when I started up, but I didn't realize to the degree of audit potential how deep they could get in your personal records. So really helpful again. And as these fears come up in these transitions, it's so helpful to get the information to not expose your individual tax return if that's not necessarily what's under audit. So good stuff.
Yeah. And then, and furthering on that, just like you don't want to have your business running through all your personal accounts, you don't want to have personal things running through your business. So we have here, do not pay non-business expenditures from the business account. From a tax perspective, that's a nightmare because again, if you get audited and you have separate business accounts, but you're running all your personal expenses through there, or even some personal expenses, that makes that IRS auditor wonder what else you're running through that account. And they're going to spend more time looking at it and digging more into it. From a legal perspective, it's a problem. And I'm not an attorney. I can't, speak to the legal side as much, but my understanding on the legal side is that when you pay personal expenses out of a business account and somebody sues you, it enables the court to say they're not treating their business entity separate from themselves. Therefore, the business is themselves and they can get access to your personal assets in a lawsuit. Again, not an attorney, but that's my understanding. It's a term called piercing the corporate veil, where they're able to come after you personally because you mixed your business and personal together.
Great point. Okay, got it. Open your bank account for anyone that's even doing business on, like you said, on the side without an LLC. Good to have a separate account.
Yeah, certainly. Same thing with credit cards. You want to keep those separate, business and personal. And then you can always transfer funds between the accounts. So if your business gets low on funds, you can move money from your personal into the business and then pay your business expenses. If you need to pay your personal expenses, you can transfer money from the business to your personal accounts and then pay your personal expenses that way. So it's a good way to keep them separated. Documentation is very important. It's the key to being able to minimize your taxable income. If you don't keep documents and records of things, keeping receipts and that kind of goes back to avoiding cash transactions where you can't keep track of that. My dad growing up was a business owner and he could start the day with $100 of cash in his pocket and end the day with it all being spent, and he has no record of it and didn't even remember where it went to. And so, in that case, you lost whatever could be a business deduction that way. So having that documentation is key. Getting receipts and running it through a bank account or a credit card is helpful. The IRS will inspect your business records, your receipts, sometimes your accounting ledgers and things like that. When it comes to doing accounting, it says generally any system that clearly shows income and expense is acceptable. So QuickBooks obviously is the more popular out there. A lot of people use QuickBooks. Sometimes QuickBooks is just overkill. Like if you're just kind of getting started, it's a side hustle, side business that you're working on, going out and getting a QuickBooks account and all that sort of stuff could be like overkill. So, but it's still good to have your own separate business account. So what I tell clients in that case is to go set up their own separate business account. And then most banks will allow you to download those transactions into an Excel file. And so is what you do is you monthly or quarterly or annually, however often you want to take a look at it, you can download all those transactions into an Excel file, take a column in that Excel file, and then categorize those expenses. So you'd categorize the income, you'd categorize the expenses, everything would be categorized in there. And then you can sort or filter by those categorizations, and it will turn it into kind of an income statement for you that way. That's basically all QuickBooks is doing. QuickBooks just takes your bank account and categorizes every transaction in your bank account and then gives you an income statement and a balance sheet based on the categorizations that you give it. And so you can do that. You can kind of shortcut that and save some money and time, just taking your bank transactions, downloading them, and then just categorizing them inside Excel and then sorting it that way.
Great options. That was going to be one of my questions, is how to do this simply and easily. So just using your bank record, got it. And then QuickBooks, fancy way of doing it. I'm assuming that has a upload and categorize and those types of things. So great options.
Yeah. And then we have special record keeping rules that are required for autos, meals, entertainment, travel, and payroll. And we'll talk about a couple of those, auto and meals and entertainment here. Now, deductible expenses. So this is a question I get a lot, and it's not the easiest question to answer. And the question is, what can I deduct in my business? And the reason why that's not a really easy question to answer is because every business is different. I was working on an IRS audit one time, and the IRS auditors saw some expenses at Walmart, and they said, "Oh, what are these expenses at Walmart? Can you give us receipts?" So I said, "Yeah." So we went back, got the receipts from the client, gave them to the IRS. They went through those receipts, and they found a line item for kitty litter on the receipt. And they said, well, kitty litter, do they have a pet? Do they have a cat? This is not a deductible thing. Pet expenses are not deductible. We're going to disallow that. And said, okay, let me talk to the client. So we went back to the client and said, hey, the IRS isn't very fond of your kitty litter deduction. Can you give us some more detail on that? They said, oh, yeah. We, they happen to own an auto repair shop. I said, in our shop, we oftentimes spill oil on the ground, and there's nothing better at soaking up oil than kitty litter. So we don't have a cat or anything. We just buy kitty litter to soak up oil. I said, oh, okay, that makes sense. So we went back to the IRS and said, hey, this was for kitty litter to soak up oil. They don't own a cat. It's just for soaking up oil. And they said, oh, okay, that makes sense. We'll allow that as a deduction. And so for an auto repair shop, kitty litter was a deduction. Now I'm a CPA in an office and I've got carpeted floors and all that. I'm not spilling oil on my in my office or anything. I have zero reason to buy kitty litter for my business. So for me, kitty litter is not deductible, but for an auto repair shop, it certainly is. Another example of that is I was one time in the IRS office doing an audit, and there was an audit manager there that was talking, and he said, I was auditing this guy and going through his expenses and found out he deducted a gun. And I was like, I got this guy. There's no way a gun is a business deduction. And so he went to the guy and says, you deducted your gun. We're disallowing that. You're going to owe us tax on it. He says, well, wait a minute. He says, I'm a construction worker, and I often get to sites early in the morning. And sometimes people move into the construction, into the sites we're building, into the buildings that we're constructing in the middle of the night. And, they're not oftentimes the most, nice people. And so they need some motivation to kind of move along. And so that gun is to kind of protect me and help people kind of recognize that I'm not anything to mess with. And that particular IRS auditor, I wouldn't say this would be every IRS auditor, but that particular IRS auditor agreed with that taxpayer and allowed that as a deduction. So again, as a CPA, I have zero reason. Nobody's moving into my office in the middle of the night or threatening me or anything like that. So I have zero reason for a gun. So if I ever tried to deduct a gun, it wouldn't fly. So, instead of giving people lists of what's deductible, because we certainly would miss things or we'd include something on a list that's not deductible others, we rely more on the definition of what is deductible. And the definition, the legal definition is it's an expense that is both ordinary and necessary. So ordinary means it's common and accepted in a particular industry. And then necessary is helpful and appropriate for a particular trade or business, even if not indispensable. So a couple examples of that, like a business license is required to be in business. So that's a very common, ordinary, necessary expense to be in business. However, marketing and sales and advertising and all that sort of stuff is not really required to be in business. People start up a business and they can do organic marketing, they can do other sorts of things. They don't necessarily have to pay for advertising. However, it is a helpful and appropriate expense. And it's very common and ordinary to have that sort of an expense. So if it's something that advances and helps your business along, then it is likely a deductible expense that way.
Yeah, and what a term that's coming to mind too is like application is everything, right? If you need the kitty litter for certain purposes or the advertising for other purposes, you can point exactly to the application of that purpose in your business.
Right. Yeah, exactly. Yep. That works well. We do have some non-business expenses. So charitable contributions is a very common one. People always say, oh, I'm going to make a charitable contribution. Should I do it out of my business or should I do it personally? Charitable contributions are not actually a business expense. If you're a sole proprietor, there's no line item on a Schedule C for a charitable contribution. Whenever we have a client that gives us their income statement and they have charitable contributions and they're a sole proprietor, we move those over to Schedule A on the individual return as an itemized deduction. When it's a partnership or an S corporation, when there's a charitable contribution that comes through there, those get classified. A K1 is what comes out of a partnership and S corp, and a K1 tells the owner of that entity how to report the business income on their personal return. So whenever there's a charitable contribution out of a partnership or S corporation, the K1 puts those charitable contributions on a specific box in that K1, and that box then goes on to Schedule A. So if you make a charitable contribution out of your S corporation and think you're getting a deduction for it, you're actually not. It's ending up as an itemized deduction on your personal return. And if you don't itemize deductions, you're getting zero benefit for that. We have here, say, consider advertising. Sometimes charitable contributions are actually more advertising. If you sponsor an event and you get your name on a t-shirt, or you get a booth at the event, or you get your name mentioned, you get some kind of publicity for that, then that's more of an advertising expense than it is a charitable contribution. And advertising is fully deductible as a business expense. And so take a look at that charitable. Is it more advertising or is it really charitable that you're doing there? And categorize those appropriately on your income statements. Penalties and fines are not deductible. Political contributions and lobbying expenses are not deductible either. And then owner's health insurance is not a deductible expense on the business side. It gets claimed on the 1040. There's a line there as self-employed health insurance, but generally it's not deducted in the business. All right, that's deductible expenses. Now we'll get into auto expenses. Auto expenses is an area that comes up a lot as well because people have cars, they drive them. There's two ways to do the deduction. There is the standard mileage method, and then there is the actual method where you depreciate the car and you report the gas and oil changes and all those sort of expenses that go on there. Under either case, the deduction is always based on the mileage. So if somebody buys a car and they say, okay, I'm just going to deduct this, I'm going to depreciate it, I'm going to keep track of the gas and all that sort of stuff, so I don't have to worry about keeping a mileage log, that's not going to work very well. The IRS always wants to see a mileage log whenever a vehicle is deducted, because that mileage log proves how much you use that vehicle for business. So if you go out and buy, say, a $50,000 truck that you plan on writing off, depreciating, the IRS will say, hey, that's great that you bought a $50,000 truck. How much do you actually use that for business? And if you tell the IRS, oh, I use it 100%, they're going to want to see proof of that. Your proof of that is keeping a mileage log that shows where you drive that car, day by day, trip by trip, wherever that car goes. And so the deduction may be disallowed if you don't have mileage records. We've run into that in some IRS audits before. And you want that mileage record to report commuting miles, business miles, and non-business miles. So anywhere that car goes.
Keep it handy.
Yeah. And there's some great apps. There's Trip or Mile IQ is the most popular one out there. And then TripLog, that's one I started using 8 years ago when I started my business and became self-employed. And I think Mile IQ is the same as TripLog. Like when I get in my car and the phone connects to the Bluetooth in my car, this app turns on and it then GPS tracks everywhere I drive in that car. And so for the last 8 years, I can go back into that app and see everywhere I've driven my car. And then I just categorize it, whether it's business, non-business, charitable, all that sort of stuff. You can categorize it that way. So it makes it kind of a default way of just keeping track of miles. As we mentioned, there's 2 methods to compute auto expenses. There's the actual costs. So you'd keep track of all your gas receipts, oil changes, your insurance, repairs, lease payments, registration. Then you depreciate the car that way. So let's say that the actual costs were $12,000 and it was used 80% for business. So that'd be a $9,600 tax deduction in that case. Or you can do the standard mileage rate. And the standard mileage rate changes from year to year. So last year in 2021, it was 56 cents per mile. For this year in 2022, they did a hybrid. For the first part of the year, it was 58.5 cents. And then gas prices went up so high, the IRS said, okay, we need to raise the rate. So halfway through the year, they raised it to 62.5 cents per mile. And so if we take 20,000 business miles that this car's driven, and so let's say in 2021, it was 56 cents per mile, well, that's a write-off of $11,200. If we look at it for 2022 and we split it between the year, 58.5 cents and 62.5 cents, well, now that's a $12,100 write-off for this year, for 2022. So you can see how just the change in mileage rate can increase or decrease that deduction, even if you have the same business miles on there. And you can see in this case that our mileage deduction was more than our regular deduction, which can happen depending on how many miles that you drive for business. All right, this is breaks all the rules of PowerPoint slides. It's just kind of all over the place and a headache to look at, and I know that. I'll sum it up really, really simply for you. Basically, all of this stuff is just calculations to say, if you drive 8,000 miles per business versus if you drive 35,000, I kind of took 2 extremes, one extreme on the very low end and one extreme on the very high end. 35,000 miles a year is a lot of miles to drive. But basically down here at the bottom, it just says, okay, what's better? Is it better to take the actual deduction and depreciate the car, or is it better to take the mileage deduction? And in this case, as I put all of this stuff in there, there was a change between 10,000 business miles and 15,000 business miles, where it actually became more beneficial to write off the mileage rather than to try to take the actual. A lot of times people will go out and they say, I need to save money on taxes. I'm going to go buy a $50,000 truck and I'm going to write it all off because the tax code allows you to write off really big vehicles all in 1 year. So they say, I'm going to buy a really big truck and I'm going to write it all off in 1 year. Well, that's great if you go and do that. However, your deductions in the years going forward that you own that vehicle drop off significantly because you no longer have depreciation on that car. And if you're driving it for mileage, you're driving it a lot, the mileage deduction can actually be a much greater deduction. You can see here that at 15,000 miles, the actual deduction was 55,000, whereas the mileage was almost 70. So you've got a $15,000 difference over the life of that vehicle. And then some people say, well, that's great. Is what we'll do is we'll buy a car, we'll write it all off, and then we'll switch to the mileage, which would be awesome if you could do that. Unfortunately, there's this rule that once you use the actual method, once you've depreciated that car on a tax return, you cannot then switch back and say, okay, I'm done depreciating it, and now I'm going to use mileage. That would be the best. Yeah. You give the best.
Double dipping. Do we call that double dipping?
Right, exactly, yeah. Because the mileage rate actually includes a depreciation component in it. So
sure.
Parking tolls, loan interest can also be deducted when using the standard mileage rate. So just because you're using the standard mileage rate doesn't mean there's not vehicle expenses that you can't also claim. And then mileage logs need to be as detailed as you can. That it's not sufficient if it's too generalized, and then or not supported by other corroborating evidence, which is a really big word, corroborating. But corroborating records support amount, time, place, business purpose, business relationship. So as an example, if you have on your mileage log that you travel downtown to meet with a group of people that you work with, and you talk to business, the IRS will say, "Oh, hey, that's great. We see that you drove there. Where's the receipt from the lunch that you went and had?" They want that backed up and supported by some kind of receipt or an expense that you have associated with that. Also, when you get audited and you have a mileage log, the IRS asks for your oil change receipts, the record from the oil change. And the reason they do that is because when you go and get your oil changed, the first thing they do is they
Like your
look
mileage.
at
Yeah.
they record your mileage, right? Yeah. And that mileage is recorded on that date and time. And the IRS wants to see that the mileage on the oil change receipt matches the mileage on your log. And if those don't match, then you got problems. Then the IRS they think they can't trust your mileage log, and they start to disallow any vehicle expenses because things don't match up that way. So, yeah. Auto expenses. All right. Okay, moving on to our next one, meals and entertainment. Another really popular deduction is meals and entertainment. Everybody goes out to meals with clients and customers and other things. Generally, meals are limited to 50%, that you can only deduct 50% of the cost of those. However, there's a special rule for 2021 and 2022 where meals from a restaurant are 100% deductible. So we've got 2.5 months left this year that our meals are still 100% deductible. And then when we get into 2023, they go back to being 50% deductible again. And then entertainment is no longer deductible. The 2017 Tax Cuts and Jobs Act disallowed an entertainment expense starting in 2018. And you want to keep good record. If when you go out to lunch with somebody and you pay for it, it's really good to take that receipt and on the back of it write who you were there with and what type of business was discussed. Because if you get audited and the IRS looks at those, they're going to say, okay, how do we know this was a business meal? And if you show them the thing, you say, oh, I went to lunch with these people. This is my business relationship to them, and this is what we discussed. Then that starts to prove a business reason for that meal. All right.
I'm having flashbacks, as I'm sure some of my peers are that are our peers are that are on the call, of thinking, oh my goodness, as I'm doing my expense report for a corporation, how many lines? And then luckily there were processes in place to get audited internally before they went external to the actual IRS or at the company level. But it's like, okay, there were those practices in place, and it's important as you're, an entrepreneur, if you're going to make the deduction, to be disciplined, just as the corporation was, because there's the same amount of audit risk as there is, or at least I'm told to believe it's random, right? So good practice for everyone, no matter where you're working or employed from.
Yeah, yeah, certainly. Okay. And then this is a nice chart, because basically meals and entertainment fall into 3 different buckets. They're either 100% deductible, 50% deductible, or not deductible. Basically, the simpler one is this one that's in the 0 column. These are entertainment with clients and prospects, year-end party for your customers, or going to a golf, theater, football game, sporting events, anything like that with a customer, all 0% deductible. The 50% deductible is the meals, for this year, meals that don't come from a restaurant, or when we get into 2023, it would be all meals. So meals with clients, meals for your employees that you would have on staff. If you go to a Chamber of Commerce meeting, things like that. If you're traveling away from home, then those meals are 50% deductible when we get back into 2020, when we start 2023. The things that are 100% deductible is if you have a year-end party for your employees and spouses, that's viewed more as like a team building event, and they're 100% deductible. Same thing if you take your employees and spouses out golfing. So you can take a customer out golfing and it's 0% deductible, or you can take your employee out golfing and it's 100%. Then you'd say, okay, well, that's great. I'll take my employees when I take my customer, but it doesn't quite work that way. You have to be careful with that. If you have customers at an event, then it turns it more into a customer event that makes it not deductible that way. Team building, recreational events is 100% deductible. And then also meals for the general public at a marketing presentation. You know how sometimes in the mail you get those things from like a estate planner or a financial planner or something. They say, come down to this restaurant at this time and this date. We'll buy you dinner and, sit and listen to our presentation. Those are 100% deductible because it's a marketing type of an event that's open to the general public to come and do that. So something to keep in mind if you're working on building your clientele that way.
Great.
Okay, the home office deduction is another area that's very popular and comes up quite a bit. People have various reactions to home office deductions. They often think that it's going to get them audited if they take a home office deduction. Well, I've been doing taxes for about 20 years. I've had my own personal clients for probably a dozen years or more, filed hundreds and hundreds of tax returns, thousands at this point, thousands of tax returns, and hundreds of returns that have reported a home office deduction. And to this date, the number of clients that have been audited, my own personal clients that have been audited, are 0. I've talked a lot about audits that I've been through. That's when I worked at really big firms that had clients under audit. That's all my audit experience. And so for the last 8 years since I've been on my own outside of a big firm, I haven't seen an IRS audit, and never has one of my clients been audited. So I have 0 issue taking a home office deduction because I have 0 experience of it ever being audited by the IRS. If you have a home office and you get audited by the IRS as part of taking a home office, they will definitely want to come and see that and verify that you have a home office. Typically, they want to verify this number one thing, exclusive use test. So it's an area that has to be used exclusively for business. You can't just take your guest room and call it your home office, because if the IRS comes and looks and they see a bed in there, or they see kids' toys, or they see anything else that's personal, they'll disallow it because you're now using that space for personal purposes as well as business. So it has to be exclusively used for business. It needs to be used regularly. So it can't just be the room in the basement that's our home office down there. It has to be something that you actually use. It needs to be connected with a trade or business. You can't claim it currently as an employee. So if you get a W-2 and you have a home office as part of that W-2, those are currently not deductible. It has to have some kind of trade or business that goes with it. And it needs to be a principal place of business, a place that you're conducting your business there. That's home office. And then there's 2 ways that you can deduct it. There's the standard deduction, which is $5 per square feet up to 300 square feet. So if your home office is 150 square feet, you times that by 5, your deduction $750. It's as simple as that. You don't have to keep track of utilities or anything else. Or you can do the actual home expenses, and then that you just take the ratio of your home office versus your total square footage. So in this case, we have 150 square foot home office divided by 2,000 square feet for the total home. So that's 7.5%. So we times that by the total expenses, which would include rent, interest, property taxes, all those sorts of things. That the total of those will say is 20,000. So in this case, the write-off would be 1,500. Unlike the vehicle, because vehicle had the standard mileage and then the actual, but once you did the actual, you can't go back and do the standard mileage. That's different for home office. You can actually switch back and forth from one year to the next of which one you use. So yeah, that's helpful. All right. And as we finish up here, last slides, just some other items to consider. W-9 from vendors is important to get to issue 1099 forms. Anytime you pay somebody $600 or more for services, the tax code requires you to issue them a 1099. Those 1099 forms are due by January 31st. So once the year ends, you've got a month to get those out to your vendors, to your contractors that worked for you. The problem is if you hired a contractor, a vendor in, January of 2022, and now you're in January of 2023 and you realize, oh, I need to issue them a 1099, and it's a year later and you can't find them anymore. Yeah, now you have a problem issuing them a 1099. Maybe they moved, maybe they went out of business. Who knows what happened? So it's best practices that before you pay anybody, you get a W-9 from them so that you can issue them the tax form when that time comes. It just makes life a lot simpler and easier that way. Some other things is retirement account options. So you've got a whole library of retirement account options out there. You got IRAs, SEP IRAs, simple plans, 401ks. We can spend a whole day going through those sort of things, but just to be aware that you don't have to be employed and get a W-2 to have a 401k. You can create your own 401k. You can do a SEP IRA. They're simple. There's all sorts of options out there. And if you have a financial advisor, you can talk with them. That they're usually ones that set up those and maintain them. So they're a good resource on that. Hiring children is a great way to save money on taxes. I had a client in yesterday that we were talking about that very thing. It works extremely well if your kids are under 18 years old. You don't have to withhold employment taxes or income taxes if you pay them $12,000 or less during the year. And so it's a way to get a deduction in your business and save money that way without anybody having to pay tax on the other side of it. And there's a video on my YouTube channel that goes into more detail on that, on how hiring children works. And then the last thing is mileage tracking apps. We talked about those briefly. TripLog and MileIQ are great options there. So yeah, that covers all that.
Awesome. Super helpful. I was taking some notes myself. I'm always both a student and a teacher. I think it's so important to have a network or I don't want to say board of directors, but supportive individuals as you're a solopreneur, entrepreneur, in helping with that. And sorry, I'm just trying to get there we go. And helping answer these questions, right? As you know, I'm a business coach for corporate executives to build their business to ultimately replace their income and create an impact that they want to impact. However, I do not pretend to answer the questions about mileage, and so it's so important to gather information and create resources for yourself because. If you're desiring this, there are ways. And the first step is really informing yourself and educating yourself. So this was really helpful. I know for our audience, we had several comments, questions, helpful information, etc. So Merill, I want to ask what I mentioned what you are willing to offer anyone that's taking part, engaging, and registering for the discussion here today.
Yeah, certainly. Yeah. We can do a couple of things. If you would like help with taxes and looking at those, you can go to my website, taylortaxteam.com. There's a link on there to schedule just an introductory call, a discovery call that we can kind of talk about your tax situation and go through that and see if there's any potential ways to save money on taxes. And that would be us kind of looking through it and helping you with that. No obligation or anything like that. Just happy to kind of go through that. If you're the type that would just rather learn on your own and kind of go through it, we have the YouTube channel. I also have an online course that goes into this, all these topics in much, much more detail. And you can get that at 7percentclub.com is the link for that. And it's a weird name. And there's a video on that site that explains what that is. But yes, if you go to 7% Club, you can put your name, email, and it will send you that free course that you can go through all of these things in more detail as well. Okay, awesome. Well, that's an extremely generous offer. I know how, especially the one-on-one support
for individuals that are considering making this this deduction. And I know it kind of goes without saying, but I'm going to say it so that there's no assumptions left unsaid. But hiring advisors for your business, such as Merill and I, is a business expense. Right? You're using the knowledge and application to your business. So as we near the end of the year and you consider, where your business, where you want it to be next year, even, filing the forms for the LLC, it's going to be an expense. If you incur it this year, that goes towards and think about the year 2022 tax deductions. So depending on what your tax foresight looks like coming towards the end of the year, it may be a good time to look at deductions that Merill had reviewed, and reach out and ask and see what is applicable and what isn't. But super helpful information, Merill. I know that your clients appreciate it. I appreciate it, and getting to know you more on a professional level and the information you shared is great. But I always love to kind of close with asking a few off the cuff rapid fire questions. And as we are looking into Q4 and the end of the year, I know you're out in Utah. What is one vacation or trip that you have planned with your family?
Yeah, so we're actually leaving today. My kids have a fall break from school tomorrow and the next day. So as soon as my kids get out of school this afternoon, we are going to drive up to Yellowstone and spend a few days there. So
oh, that's so fantastic. Well, I didn't know that I was butting up so close to your vacation, but it's great. I've been there, and hopefully the roads are still there. I know that they got some of them got washed out due to flooding over the summer. But that's what a spectacular vacation to have with your kids, and a beautiful time of year to ask. And then next is, if I were to look in the car that you have packed for your trip, what is one thing that when your close friend or family would look in and say that has to be Merill's car?
Good question.
Don't overthink it. What do you go? Never go anywhere without.
What I usually go with as little as possible. So yeah, usually people look in my car and they say, it's clean. There's nothing. That's usually the comment I get. Because,
you're going to Yellowstone for however many days with your family, and where's your bags? Where's your stuff?
Yeah, we'll have that. My wife actually, I was as I was getting ready this morning, we're leaving today. We're coming back Saturday, so it's like a fairly short trip. But she had the countertop completely filled with food, more food than you could eat in 3 days. There's restaurants, there's food up there. But anyway, yeah. So our car will be stuffed with food because that's what my wife likes to bring in.
There you go. All right. Amazing. Well, Merill, thank you so much for your time. Thank you, everyone that tuned in. And we look forward to follow-up discussions after the streaming. Everyone have a great day. Namaste.